Hong Kong-listed IRC is staying bullish and continuing on the acquisition trail. The affiliate of gold miner Petropavlovsk went public in 2010 and managed to turn in a profit last year. However, some analysts are warning that the near-term outlook remains cloudy. Well, what is IRC doing to drive earnings? Well, let's get some answers from its CEO, Hambro, who joins us now from London. IRC is in a risky business exploring and developing industrial commodities, and the investment may have been made, but not all projects may come to fruition. What safety nets do you have in place to protect the bottom line?
Thanks, guys. I think there are two things that we do to protect the bottom line. The first is a de-risking of future production. So we go through the process of securing funding. We go through the process of making sure we have good construction partners, and then we have good people who will offtake the material. And the second is to maintain our cost base. So we have a constant program in place to optimize our costs, and that, I'm sure, will mean that it will see us keeping our position as one of the lowest cost producers of iron ore in the world.
Jay, I know you had $1 million in profit, net profit last year, but so far you have no operating profit because your mines are still young. Do you have any investors are quite impatient though? Do you have plans to speed up development and maybe turn a real profit anytime sooner?
Sure. Well, we did actually report a segmental profit last year, which is effectively an operating profit from our first mine. And you've got to remember, last year was a pretty evolutionary year for us because it was the year where we put our first mine into production. So fingers crossed, life will continue to be good going forward.
Well, Jay, IRC shares are down 60% over the past year. What are your plans to arrest the fall in share price and drive shareholder value?
Well, I think from management's perspective, we continue to go about the process of de-risking. As I said, we have secured the funding we need. We have secured good construction partners, a large Chinese state-owned enterprise called CNEC, and they will see us in a position to start production from our second mine, KNS, at the beginning of 2014. Now, if you assume today's iron ore price and the cost base that we're forecasting, it sees us generating an EBITDA of about $320 million a year. Now, that is about 70% of our current market cap. So I think investors will hopefully come to realize in the not-too-distant future that we are trading on a ridiculously cheap multiple and are deserving of a pretty substantial re-rating.
All right, thank you so much, Jay, for that. We've been speaking with Jay Hambro from IRC.